What can buyers do to help reduce the cost of their mortgage, or even get financing at all? What can sellers do to help assist buyers purchase their homes and still sell it for a premium? What can homeowners do to reduce the cost and length of their mortgage? We'll go over buy-downs, 15-year mortgages, 40-year mortgages, seller financing, wraparound mortgages, and how you may be eligible to get some free money to help you get into your next home. The interest rate buy-down. A rate buy-down is a way for a buyer to pay for a lower interest rate by purchasing discount or mortgage points. Buyers get to make a one-time payment to reduce their interest rate for the length of the loan. A common misconception is that 1% equals 1 point. In reality, 1 point equals 0.25% of the mortgage rate. Buying down the rate by 1 point costs 1% of the loan amount. On a loan of $475,000, a 1 point buy down would cost $4,750. That would be a savings of over $28,000 in interest over the life of the loan. A 3-point buy down would cost $14,250, but would save nearly $85,000 in interest payments. A 3-2-1 buy down is a seller's concession to the buyer that reduces the buyer's interest rate and monthly payment for the first 3 years of home ownership, making the home more affordable. The seller agrees to finance 3 years of a lower interest rate for the buyer. The interest rate for year 1 is reduced by 3 percentage points. The interest rate for year 2 is reduced by 2 percentage points. The interest rate for year 3 is reduced by 1 percentage point. Year 4 through the life of the loan are subject to the original interest rate. This is a value to seller due to it being a great negotiating tool because a greater percentage of homes listed for sale in today's market are seeing price reductions. A 3-2-1 buy down makes the house more affordable to a wider range of buyers who may have otherwise been priced out of the market. It's also a great value to buyers because they get 3 years to absorb the impact of the higher payment and can often finance a higher mortgage amount. It has a much greater impact on the buyer's monthly payment than reducing the list price of the home. The 2-1 seller buy down is like the 3-2-1 buy down, but doesn't have the 3% interest rate reduction for the first year. It starts with a 2% rate reduction the first year, then 1% for the second year, and is subject to the original interest rate from year 3 through the life of the loan. A 5-1 ARM is a type of adjustable rate mortgage loan with a fixed interest rate for the first 5 years. Generally, these are offered at a lower rate than a traditional fixed rate mortgage. The interest rate is subject to change every year from year 6 through the life of the loan. The interest rate change is based on the state of the economy and cost of borrowing. Usually increases are capped at a certain rate. The 15-year mortgage. A 15-year mortgage is beneficial to those that want to build equity in their home quickly and pay off their loan faster. The rate on a 15-year mortgage is typically lower than a 30-year mortgage. Because the payments are higher on a 15-year mortgage, buyers will be able to get rid of private mortgage insurance, PMI, sooner by reaching the 20% equity threshold more quickly. Financing $475,000 with a 15-year mortgage saves over $400,000 in interest as opposed to using a 30-year mortgage. The 40-year mortgage. Like a traditional 15 or 30-year mortgage, there's an option to take out a 40-year mortgage. An extended mortgage creates a lower monthly payment despite the interest rate being higher than the prevailing rate for a 30-year mortgage. This is an affordable way for buyers to purchase a home in today's increasingly expensive housing market. Financing $475,000 for 40 years rather than 30 would save about $35 on your monthly payment. Seller financing. When a home is sold through seller financing, the seller becomes the lender, which would typically be a bank traditional mortgage lender. The note is made between the seller and the buyer. Seller financing can offer several benefits to the seller who owns the property outright or can pay off the remainder of their existing mortgage with a down payment from the buyer. Some of the benefits include reducing closing costs, capital gains tax savings, and the ability to offload insurance, taxes, and maintenance. Buyers benefit from the ability to purchase a home without being approved from a traditional lender, flexible terms, and lower closing costs. Other common seller financing agreements include land contracts, lease to own, and assumable mortgages. A land contract is an agreement to purchase a piece of real estate that involves buyers borrowing money from the real estate owner until the purchase price is paid in full. Land contracts typically work where a balloon payment or lump sum, comes at the end of the repayment period after the plan is agreed upon between the two parties. Lease to own is an agreement under which the renter pays the seller an option fee and an agreed upon purchase price that gives the renter the exclusive lease option to purchase the property at a later date. An assumable mortgage is a type of home financing in which buyers are given the opportunity to purchase a home by assuming responsibility for and taking over the seller's current mortgage. The wraparound mortgage, an AITD or all-inclusive trust deed, is a form of secondary financing for the purchase of real property. An AITD is a new deed of trust that includes the balance due on the existing note plus the additional loan amount of the purchase, also known as a wraparound mortgage. Under an AITD, the buyer makes one large payment. The recipient of the payment, usually either the seller or a lender, splits the payment up. Part of it goes to the lender on the original mortgage, and the rest goes back to the seller as the payment on the new mortgage. A wraparound mortgage is of value to sellers because it can expand the buyer pool, as sellers can sell the home to buyers that may not have otherwise qualified for a home loan for the full purchase price amount. The seller benefits from the interest they are financing and the difference between interest paid to the lender and what the seller collects. The wraparound mortgage saves the buyer from having to apply for a traditional mortgage. By being added to the deed, the principal of the buyer's loan includes the original loan already attached to the deed. Since the buyer is purchasing the home directly from the seller, they can negotiate favorable terms with no third-party lender fees. Home buyer assistance programs. Across the United States, there are more than 2,200 home buyer assistance programs that can help qualifying individuals purchase eligible properties. There are three common types of home buyer assistance programs. First, we have DPAs, down payment assistance programs. These come in two typical forms: the DPA grant and second mortgage programs. Second mortgage DPAs vary in their payback provisions from forgivable second mortgages to repayable DPAs that accrue interest. DPA grants, or free money, can be applied to the down payment or closing costs depending on the program. Secondly, there are affordable first mortgage programs. These programs are often paired with DPAs and subsidize the interest rate for qualifying buyers seeking to purchase eligible properties. There are several early payoff strategies that homeowners can take advantage of to save thousands of dollars over the life of the loan. One is to make one extra loan payment each year. By making one extra payment per year, a homeowner can reduce the amount of interest they will pay over the life of the loan and the duration of the loan. By making one extra payment a year on a $475,000 loan at 7%, the mortgage would be paid off 6 years ahead of schedule and net over $156,000 in savings. Another option is to pay bi-monthly. Instead of paying $3,160 once a month, split that in half and pay $1,580 every 2 weeks. By switching to bi-weekly payments, the borrower will pay $493,804 in interest and will shorten the repayment period to just 24 years. The net savings would be $168,863 and 6 years off the mortgage. You can also round up the payment. By increasing the monthly payment up to a round number, a borrower can save money on the interest paid over the life of the loan and shorten the duration and term of the loan. The precise amount of money and time saved will depend on the amount of rounding. By rounding up a monthly payment of $3,160 to $3,200 every month, $32,483 will be saved in interest, and the duration of the loan will decrease by roughly 2 years. You can try the $1 a month plan. Each month, increase the payment by $1. $1 the first month, $2 the second month, $3 the third month, and so on. This could reduce the term of the mortgage by 8 years. Another tactic is to use surprise money or bonuses to make extra payments. This is the easiest way to pay down debt, including a mortgage, more quickly. More than likely, this money is not accounted for in a monthly or yearly budget, so it's easier to use in this scenario. With all that being said, do be aware of prepayment penalties. Each lender may have different rules. Here are a few other money-saving strategies. A home equity line of credit, also known as a HELOC, is a line of credit secured by the home that gives the borrower a revolving credit line. A HELOC often has a lower interest rate than some other common types of loans, and the interest may be tax deductible. Much like a credit card, you can draw on the HELOC, pay it off, and draw on it again. There are several ways a homeowner could benefit from using a HELOC. One is to use the equity from the home without refinancing, or use the equity for a down payment on a new home while keeping the current home. It could be used for large expenses, or to consolidate higher interest rate debt on other loans, such as credit cards. Also, the additional line of credit may increase your credit score. Private mortgage insurance, or PMI, is insurance that protects the lender in case an owner should default on their home. PMI is required for buyers who get a conventional mortgage and make a down payment of less than 20%. Once the homeowner has an equity position of more than 20%, the PMI can be removed with lender approval. Upon request, lenders will do a home valuation to determine if PMI can be removed. The cost of PMI for a conventional home loan averages 0.58% to 1.86% of the original loan amount per year. If the borrower has an FHA loan, they can refinance into a conventional loan once they've gained enough equity to help get rid of the PMI. You can also save money by getting rid of the escrow account. An escrow account is an account that is used to collect annual expenses like property taxes and homeowners insurance on a monthly basis. Banks often mandate the borrowers have an escrow account at closing so that they know that the borrower has the funds to pay their property taxes when they are due. However, after a period of time of perfect payment history, many banks will allow the borrower to stop escrowing. At that moment, the monthly payment goes down, although the borrower is still responsible for making the tax and insurance payments at the end of the year. If the borrower is comfortable budgeting for taxes and insurance, they can elect to not have an escrow account upon closing, thus immediately making their monthly payments lower. Another way to save is to refinance to a shorter-term mortgage. If you're able to afford higher monthly payments, you can refinance a 30-year mortgage to a 15-year mortgage, which will help you pay off the mortgage faster. One other trick is to make payments with a credit card. Now, most lenders don't accept credit cards for making mortgage payments because they think that more customer debt will result in higher mortgage defaults. However, some lenders are now accepting PayPal, and a borrower can set up a PayPal account, link it to their credit card, and make their mortgage payment from there, allowing them to earn the cash back or the points, which are often redeemable for cash with certain credit cards. If the borrower uses the cash back gained, they could help pay down the loan faster. While rare, it is definitely worth asking the lender if this is acceptable. I hope that was helpful. If you have any questions about real estate in the area, my contact information is down in the description. And for you locals or property owners here, if you're curious about how to net the most in this market when selling, feel free to reach out. Thanks for watching.